presents to you Honest Talk.
Hi folks, today we are back with one more great and leading personality, Mr. Tamal Bandyopadhyay. Tamal Bandyopadhyay is an Indian business journalist, known for his weekly column on banking and finance. Bankers Trust, published in Business Standard, a leading Indian business daily. He had started this column in Mint, an Indian business daily by HT Media Ltd. He has authored 6 books, namely HDFC Bank 2.0, From Dawn to Digital, From Lehman to Demonetization, A Decade of Disruptions, Reforms and Misadventures, Bandhan, The Making of a Bank, Sahara, The Untold Story, A Bank for the Buck, and his upcoming book, Pandemonium, The Great Indian Banking Tragedy. Bandhan, The Making of a Bank has been translated into Bengali. LinkedIn nominated Tamal Bandyopadhyay for 3 successive years, 2015, 2016 and 2017, as one of the top voices in finance. In 2018, he has been nominated as one of the top 25 voices in India across sectors. He is a recipient of Ramnath Goenka Excellence in Journalism Award for Commentary and Interpretative Writing for the year 2016. So, let's begin our talk with our today's guest, Mr. Tamal Bandyopadhyay.
First of all, sir, I welcome you to in this session. Thank you so much, sir, for joining and agreeing to share your thoughts with us. We are extremely very happy to have you for today's talk.
Thank you. Thank you.
Thank you so much, sir. It's our pleasure to have you. So, sir, moving to the topic of today's session, which is on the name of your book only, Pandemonium, The Great Indian Banking Tragedy. So, the first question which I would like to ask you about your upcoming book, what is the inspiration behind writing of your book, Pandemonium, The Great Indian Banking Tragedy?
No, it's not an inspiration actually. It's an incident. What happened is sometime in 2019, late 2019, last year, our finance minister, she had a session at Columbia, the law school. And by invitation, the previous finance minister also, from 2017 onwards, Indian finance minister do have sessions there. They talk about Indian economy and banking. Arvind Panagaria was the moderator of the session, and she spoke about India and how to take India, make a 5 trillion economy. And then there was a question answer session. So one of the gentlemen stood up and asked a question where he exactly, I can't quote it verbatim, I don't remember, but something on this line. He said that he referred to, this gentleman referred to former RBI Governor Raghuram Rajan's one of the speeches, and he said that Dr. Rajan has mentioned that one of the reasons why things are not moving well in India is a too centralized power. The PMO is doing everything. That's the kind of, do you agree with that? Something like that. And she was, she was quite taken aback, I think, with that question. She took her time and then she answered in a very meticulous, detailed way, very long answer. Essentially, she said that we are thankful for Rajan for the AQR, asset quality review, which Dr. Rajan has done. I have tremendous respect for him as an economist, etc. But the Indian banking system had the worst time during when Rajan was the governor and Dr. Manmohan Singh was the prime minister. So these two, they are sort of responsible for the mess that's the Indian banking. So one of the, somebody was in the audience, he called me up from New York. So I got a call in India, and they think that what's happening? We are hearing your prime minister, your finance minister blaming Rajan and Manmohan Singh for the mess in banking. Do you agree with that? So then I got the idea, why not try to figure out who is responsible for this mess? So if you ask me, the trigger was that particular minister. The phone call from New York. One of the persons I know, sort of that gentleman invests in. He oversees a large fund which invests in India. His phone call. That's how it happened.
All right, sir. I think the talks we are going to do in this session, I think it will be beneficial for our viewers, and I am pretty sure that we are going to learn a lot from this session. Sir, my next question to you, or it's a kind of request you, kindly tell our viewers, sir, why did you name your book Pandemonium?
Say, Pandemonium is essentially you hear this on newspaper headlines and all, and it's there's a pandemonium in Parliament, because the opposition was making all kind of noise, so on and so forth. So it's basically an uproar, but which is little short-lived. That's what pandemonium normally use. But I actually chose the word from Milton's Paradise Lost, where he used the word pandemonium. So from there, it's essentially what my understanding is that the Indian banking segment has been through hell kind of stuff. And you also see what you call it, the fight between the Asuras and Devas, and then find that Samudra Manthan, and the vish, the poison came out of this, and then Shiva had that, after the Samudra had that poison, halahal, and became the Nilkantha, and that's how Shiva saved the world. And in the book, what I am trying to say is this: we have this Manthan through the Reserve Bank of India's unique asset quality review, which forced the banks to come up clean. The lots of bad assets they are hiding, it came up in the open. But now, who is the Nilkantha who will actually, have this halahal and clean up the system? The government, or what else? I mean, because the government is the owner of a large part of the banking system, but because of fiscal constraint, it has not been able to, it won't be able to capitalize as much as the banks need to keep them running their growth capital, or even for their survival. So should the government give up ownership in certain banks? Should it look for privatization, etc., etc.? So it's in the search of the Shiva, the Nilkantha, who will actually consume the halahal and clean up the system. So that's what my way of looking at things, why I have done this pandemic.
It's really very great to listen all these things from you, sir. My next question to you, or it's a kind of request again to you, sir, explain our viewers, how did the financial crisis affect banking sector?
No, when you talk about financial crisis, typically you refer to the 2008, what happened in US, the Lehman crisis and all. But we were not affected by that as much as most of the other parts, developed markets and all. Our crisis actually, is there any definite answer? I don't know, but the book is in search of the answer, and it goes back and forth. I raised many questions, like for instance in 1990s when the Reserve Bank of India decided to go for universal banking and abolish the development financial institutions, the IFCI and ICICI and IDBI, they are all converted into banks, etc. So there's nobody there to give the long-term money for project financing and all. So banks now, since then banks have been entrusted with the job, but the banks do not have the expertise. Banks are only good at giving working capital. Over a period of time, they have not even learned even till now. And all the attempts to create financial institutions to finance infrastructure, be it ILFS or IDFC, they failed. They did not succeed. The other instruments, also take-out financing, etc., did not work. We still do not have enough depth in the corporate bond market. So we have been predominantly bank-led financial system. Which is why it's also not very easy for regulator to catch the bank what they're doing, because in US, when you have when your dependents are to a large extent on the corporate bond market, etc., you can catch the defaulter very fast, because this entity has not been able to pay back redeem the bond. It's in the open, you can't hide it. But here you can end up, there could be a relationship between the borrowers and the banks to hide it, and there are various ways of hiding it, and which the banks were doing. There are multiple reasons. Behind that, why the bad loans have happened. And once the bad loans happened, particularly after the we have a very golden period of Indian economy between 2006 and 2008, when the economic growth was 9% plus, when inflation was relatively low, and the credit growth was 3 times or more than 3 times the GDP growth. That was after 80s time. And then you have this Lehman crisis and the new governor Subbarao coming, and then you have an ultra loose monetary policy, and then there is a lot of pressure from the government, etc., to ward off the impact of Lehman crisis, to give loan, create demand, so on and so forth. And in the process, what happened is this: we saw very high inflation, and current account deficit also rose. And then Dr. Rajan came in. And in between, what happened during the second half, the second part of UPA government led by Dr. Manmohan Singh, there was a complete policy paralysis. Things were not happening. Banks were giving money for the projects, but projects were not taken off for multiple reasons. There were legal issues, there were environmental issues, etc., etc. So banks were getting saddled with bad assets, but they were finding innovative ways how to camouflage that. I mean, in banking policy, they called evergreening, and keep the balance sheet, intact. And here again, we have a majority government-owned banks, and they are very target-oriented. And the targets are not in terms of financial parameters like how good you are, ROE and ROA better. No, the targets is all about how much money you can give, how much lending you can do, how big you can make the balance sheet. So there's a pressure from the government. There's a hard mentality by the banks. So one bank does something, every bank does that, and does everything else. And they were finding it a lot of innovative ways of camouflaging their balance sheet, keeping them happy. So Dr. Rajan found out a very critical part. What he said, essentially he found out that the corporate India, many of them, they are not bringing their own money. They are not bringing their equity. They are actually using bank money for both equity and debt. And he said that, and bankers were happily doing it. And camouflaging it. And he says that, you can put lipstick on a pig, but a pig cannot be beautiful. So the bankers were doing that. They're putting lipstick on their balance sheet, but balance sheet there are fault lines. And then RBI created a new system called Trilic, where the banks had to give their data, real-time data on the loans of certain amount or more. And from that, RBI could find out that one particular account is bad on one bank's book, but good on another bank's book. That actually expose the soft underbelly of Indian banking system. And so RBI had that conducted the first of its kind intensive audit called Asset Quality Review, AQR, which essentially said, look, we don't trust you, my guys will go and check your balance sheets. And then they figured out that how bad was the situation. And the banks were given time for 6 quarters, from the December quarter of 2015, then the 4 quarters of 2016 till March 2017. The banks were told that you have to come up clean within the time. And if you look at the data, till 2015 September, banks' balance sheets are pretty good. But then from then onwards, it started deteriorating very, very fast. And in 2019, India has the second highest bad loans in Indian banking industry among the G20 nations after Russian Federation. So the book talks about everything, and also beyond that, the frauds, what happened in Yes Bank, what happened in how Chanda Kochar behaved and took the board for a ride. The board was eating out of her hand, and ICICI Bank, how she was managing. How Rana Kapoor made Yes Bank into My Bank and finally No Bank. Why ILFS collapsed and Bian Housing collapsed. All those things are there. And also the overactivism of the investigative agencies like CBI and CVC and EDs and all. How the bankers were hauled up and arrested and thrown into a thorough jail. So it's a You can call it a sort of untold story. You can call it an insider account. So it's beyond data analysis. Actually, I tried to tell the story. That's not all of my books I've tried, but this is the most challenging one.
All right, sir. It was really a very quite insightful answer from you, from your side, and I think today we got the privilege that we are listening all these things from you. Sir, my next question to you: first chapter of your book, upcoming book, is "Who Killed Indian Banks?" What actually it presented? You have presented in it.
No, I mean, I don't want to repeat. As I said, I have actually raised certain questions and I have explored answer, but do I have the definitive answer? No. So the book takes off from India's finance minister Nirmala Sitharaman's interaction with that audience at Columbia. And from there, because she blamed Manmohan Singh and Raghuram Rajan, so I asked the question, should these two gentlemen be blamed for the mess, or do we explore what are the other contributing factors or individuals? Then I, as I said, got into all this, the abolition of DFIs, banks' inability to finance long term because they have not learned the lessons, the absence of corporate bond market, and the various kind of innovations which the banks have done to camouflage and to keep their balance sheet happy, and so on and so forth. So there is no definitive answer. But as I explained to you, I don't want to waste your time again repeating the same thing. There are multiple reasons. There are many constituents who have contributed to that, including the government, the majority owner of the bank. And it's because unfortunately the regulations are not ownership neutral, and it's not the ownership per se, but how the owner behaves. That's what's important. Like in Singapore, DBS Bank was floated by the government for certain purpose, and look at where the DBS Bank is. The biggest bank in Singapore, and doing a phenomenal job, because the way there's an arm's length between the owner and the management. But here, government doesn't exactly behaves the way it should. So it's not the ownership per se, it's how the owner behaves. That's also important. So I have not spared anybody. I have also tried to flag up certain issues where I found RBI is not as efficient as it should have been in terms of regulations and supervision. So it's a government, it's the Reserve Bank of India, it's the policy paralysis of the Manmohan Singh government, which ended in 2014. It's the bank's hard mentality. It's the bank's lack of efficiency. It's the bank's lack of inability for risk management. So there are multiple reasons. There is nothing one single. And as I said, I do not have the answer. I've only merely raised the question and explored the answers. There is no definitive answer. It's up to you, to figure out what exactly went wrong. I only tried to get it. So the book combines a sort of, a bird's eye view as well as a fly on the wall kind of account. So it's have both macro and micro.
I think, so your upcoming book, readers will really find it very, very interesting, and I recommend that all the viewers go and please have a look of the book and read it. Sir, my next question to you: what is the bad loans problem, and when did it actually begin?
No, if you see the bad loan is what is a bad loan? You are a bank and you give money. So you take money from you, me, everybody else, right? That's the deposits you get, and you use that deposits plus little bit, plus your capital to lend. Now there are various norms. There is priority sector lending. 40% of your loan need to go to the so-called priority sector, and then the rest of it can be retail and corporate, etc., etc. And of course, you need to also buy the bond under the norm SLR. So out of 100 rupees, 3 rupee you keep with Reserve Bank of India in the form of cash reserve ratio. Then the rest of it you buy government bonds under the norms you are compelled to buy, and you end up buying more than what you require because that's a safe investment and sovereign bond. And then you give loan, and then the loan turn bad. That's what is an accounting practice. Within 90 days, if somebody, if there are various categories of bad loans, like 30 days you don't pay, it becomes SME 0. Then 60 days you don't pay, it becomes SME 1, special mention account. And 90 days you don't pay, it becomes SME 2. And that's how it becomes a bad loan. Now, India introduced this in the 90s, and it has been evolving. It's in sync with the international norms, the Basel norms. So in the 90s, 1993, 94, we had massive bad loan in the system, much more than what we are seeing now. And then the cleanup happened, etc., etc. And we had pretty good health. But then, as I explained to you, post Lehman, the exuberance and the overlending, and the corporate India taking the banks for a ride. In some cases, even nexus between banks and corporate India. In many cases, banks are worried of exposing their vulnerability, their balance sheet. You don't want to tell the world that you are not in the best of health. Why do you hide? Because for every bad loan you need to provide for. Now, if you provide for, which means your profitability gets affected and you need more capital. So that's the reason you keep on hiding. You don't tell the world how much bad loans you have. Because what happens when the loan goes bad, you not only stop earning interest on that, you also need to provide for, set aside money for that. It's a double whammy for you. So it affects your balance sheet. Now, in public sector banking, which till recently, about a few years back, was 70% of the Indian banking, what happens is this: the CEOs have very short tenure, 2 years, 1 year, 3 years. So everybody wants to live with a happy note. So what happens when CEO comes and he just cleans up he comes with a broom, he tells the world, my predecessors are not so good, there is a lot of bad loans, etc., etc. I need to clean up. And then what happens as he moves on towards the retirement, towards the end, he ends up doing the same thing. He does not recognize the bad loans, and he lives with a happy note with a good balance sheet. And this cycle goes on till recently. Now, of course, we are looking for consolidations and other things, but that has been the story. It's a combination of yes, bankers irresponsibility, bankers inefficiency, bankers inability for risk management, for credit appraisal, corporate India's proclivity to take the banking system for a ride, hard mentality of the bankers, and that basically balance sheet growth is the overarching aim, nothing else. So it's a combination of multiple reasons. That's why we ended up this, which rose as much as 10% plus in 2019. So, and then in 20, it has come down in March. Numbers just come down, and we are just hoping that it will get better, because bad loan recognition part almost over now. You start recovery, but then the COVID attack has come. So we need to wait and watch. We thought early this year, by January, February, we thought that the worst is behind us. But now, no more, because things have changed because of COVID. And the Reserve Bank of India also says that bad loan will go up again.
All right, sir. Again, it was really a very quite insightful answer, and I must say that you have very beautifully explained that how what actually the bad loans are. And I must say, the viewers, those who are watching this session, of course, it will be beneficial for them to understand this. Sir, I don't want to take you much time, so moving to my last question of this session. So the question is, how Yes Bank actually became no bank, and why did Yes Bank collapse?
Well, it didn't collapse. It would have collapsed but for the intervention of Reserve Bank of India and State Bank of India, led by State Bank of India, a group of investors, including HDFC, Kotak, Bandhan Bank, etc., coming on the rescue. Now, Yes Bank is a classic case. What happens in India, and it's a globally in banking business. The banker becomes bigger than the bank. Actually, you and me, we bank with a banker, not a bank. Ultimately, so it's a very personality oriented, the personality cult, we believe in that, and globally it happens. Now here is a promoter, Rana Kapoor, who got one of the rare instances. Another instance was Ramesh Kelly of Global Trust Bank, which also had to be rescued by it was merged because it was not well managed. he had too much of exposure in the stock market and paid the price. So that was an individual got banking license. Here again, here a few individuals got banking license, and Rana Kapoor's model was slightly different. You know, India does not have any junk bond market, which you have in developed market like US. Junk bond is what? It's a high risk, high return instrument where you earn higher interest and you take a bigger risk. Now, Rana Kapoor tried to create a junk credit market. Guys who could not get credit elsewhere would have come and got the credit from Yes Bank. So it's a high risk, high return business. And he is also, as a part of the business model, he was also charging them very high processing fees. So you get very high processing fee and you get very high return in terms of interest rates. So if you can manage first 2-3 years to get, then you can recover much of your money. And then even if the account goes bad, you need in the banking parlance, what you call, you get a haircut, but by that time you have already made your money. That was the business model he was doing. Now, well, we can't question he was trying to do that. That's fine. But then certain other things ended up, which actually led to the fall. One is this: he was trying to manage how the loans would be kept standard and not bad. These are called in banking policy called sharp practices, within bracket, within inverted commas, sharp practices. It's not exactly illegal, but you figure out how to do it. Like for instance, one loan is going bad in my books. I figured out and I ask somebody to take it from me, and then after some time again I bring it back. Or one particular promoter, one particular project has turned bad, it's turning bad into my book. I figured out how to give him money in some other ways for some other project, and whatever he needed there, I pay him instead of X, I pay him double X, so that that money was could be used to pay back my money. So those are the things he was trying to do. And then the yet another dimension is, and which I said that he turned into my bank, he was actually his own ambition, his own family offices, 100 plus companies floated by his wife and daughters. So at the end of the day, he was doing a lot of things which was completely, which is a big no-no, which was floating all the norms of corporate governance. He had a board which essentially aligned to him. He had people in the banks who were actually working for his family offices, not for the bank, but they're on the bank payroll. So ultimately, he was actually, everything was, the goal was creation of personal wealth. And one whistleblower letter which reached the governor sometime in 2018, and that letter spoke about a particular deal where a property which was given, which was used as a collateral to get loan from Yes Bank, when the loan turned bad, that particular property, it's a very fancy property in Delhi, was picked up by Rana Kapoor's family. Now, when you want to use the collateral because the loan turned bad, you can't just buy it yourself. It has to be, there has to be auction, there has to be price discovery, and so on and so forth. So that actually blew the lead on this, and RBI started investigation and then figured out that was not the only deal. There are many more deals, and Rana Kapoor had to go. And once he had to go, they tried with a new with an experiment with a gentleman, Mr. Gill. He was picked up from, he was chosen as Rana Kapoor's successor, but he was there for about a year. But there are a lot of issues. He was not exactly had the freedom to work the way he wanted because the board was not cooperative. And of course, by the time the bank almost became insolvent, so much of his energy was, was going into raising the money and capital, so on and so forth. So he could not come up trumps. And finally, and there are many other complexities involved, like the pricing of the money to be raised at what price. SEBI norms came on the way, so on and so forth. And the book graphically described everything. And the RBI actually was in touch with PMO, and there was a date fixed by which time it has to be resolved. Ultimately, money came from the foreign investors, 500 million. It was kept in a bank. It flowed into a bank in an escrow account in New York. It was not too little, but it was too late. They could not wait. So State Bank of India and others came to the rescue. And this is, mind you, it's a very different story. It's a unique rescue act never attempted in India before. Because whenever in the past I spoke about Ramesh Gilli's bank, they are all merged with somebody else. But here, the bank has kept his own identity. The new investors came in with money, and hopefully they will make money. So it will not be exactly a charity by State Bank of India and others. 4 years down the line, they will probably make good money out of that investment.
All right, sir. Thank you so much, sir, for sharing all these things with us. We are extremely very privileged to listen all these things from you. And also, I think it was really a very healthy discussion with you over the topic. We look forward to conduct more session with you. And sir, from our side, from the side of YouTube channel Freak Folks, we wish all the best wishes for your book, upcoming book. And sir, we look forward to conduct more session with you. Thank you so much, sir, for joining and giving your time.
Thank you, Harsha. Stay safe. Thank you.
Sure, sir. Thank you so much.
Thanks for watching. Please like, share and subscribe.